Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. Today, we continue our series on real estate, and we have James Kaw with us. James is a financial advisor at Edward Jones. He's my trusted source for information in the industry. Good morning, James. How's it going?
Very well. How about yourself?
I'm good, good. Busy morning, but I'm doing well.
Nice.
Yeah, so James, as part of your service, you help clients really, walk through the financial strategies when it comes to purchasing or investing in real estate. Can you tell us a little bit more about this?
Yeah, today I'm going to focus from a couple different perspectives and just really helping clients and buyers understand what risks are involved with saving to buy a home, investing for either primary property or also in investing for, utilizing it as an investment property. So really looking at the numbers and then helping people measure their risk and help determine what risks are involved. And so, like all things and most things in life, you're always going to encounter some type of risk when saving for buying or investing in real estate. And really, it's my job to help educate people and then have them determine their risk based on their risk tolerance, their time frame, and the need for real estate, whether it be primary residence or investment property. So today, like I mentioned earlier, we're going to focus on understanding different ways to save, to buy or invest in real estate in Oahu. So the first risk, and this is mainly with saving to buy real estate, is principal risk. And essentially, is the money that you're saving guaranteed to be there when you need it? So, utilizing your checking or savings account, the benefit of that is that there's no potential loss of principal. It's going to be guaranteed to be there. One of the considerations, as probably most of you know, is that in a low interest rate environment, you're potentially losing purchasing power over time, especially out here in Hawaii with real estate. And so the best ways to preserve or protect your principal, like I mentioned, is your checking and savings account. But do consider that the bank only insures up to $250,000 at the bank. The next risk that I discuss with clients is oftentimes investment risk. So if the money you are saving is invested, how liquid is it? And is the principal protected? And oftentimes the answer is no. But the benefit may be that you can potentially maintain or in some instances increase your purchasing power over time. And the consideration is potential loss of principal dependent upon what the type of investment is. Okay, so some considerations people may ask about investing in cryptocurrency, investing in the stock market, mutual funds, bonds, or in real estate. Now, this is the type of risk that I tend to focus on the most when helping direct clients to really understanding real estate and it mainly as an investment. Okay. And so with purchasing power risk, if my money is sitting in cash or savings, do I maintain my purchasing power over time? And in a low interest rate environment, you most likely will lose your purchasing power over time. So I bank at Bank of Hawaii, my savings account is paying me 0.02% interest. Okay. So again, buyers need to be better educated about understanding their purchasing power risk. And then the question that everyone asks related to buying real estate in Oahu is, on average, what does your money need to earn in interest or earnings to maintain your purchasing power for real estate on Oahu? So that's what we're going to try to address today. So looking at the numbers, so we can't predict the future and know the future for certain, but we can look at the past and really understand what the Oahu real estate market has increased over time. So if you're saving to buy your first home or a primary residence, you need to know, what does your money need to earn or grow at to maintain your purchasing power? If you're buying it as a secondary or an investment property, the biggest mistake that I see people do is really understanding the difference between real return versus nominal return. So I'll get into that later on in the presentation. So if you go to the Honolulu Board of Realty, you can see past historical data that tracks back to 1985. So what I'll do in my nerd work is really look at the figures, look at the numbers, and help people understand what their money needs to grow at, just to ensure that you buy that same house today, and if they need to buy it 5 years from now. Okay. And since 1985, the average annualized return for a single family home in Oahu is 4.84%. And a lot of people say, James, that's not accurate, because they look at the dollar amount and then they see the growth based on their property value. So basically, if real estate on Oahu, is pretty high in terms of the dollar amount, so they think it compounds and grows at a much higher percentage. But again, if you look at the Honolulu Board of Realty, that you'll see that the average annualized return for a single family home in Oahu is 4.84. And we want to be real conscious of that number. And then why does it matter? So just to ensure that these aren't figures that I made up, you can visit the website and then you can see that since 1985 up until last year, a 33-year time span, the average annualized return is 4.84%. So the reason why it's important is because if the money you're saving up over time isn't earning 4.84%, you're essentially losing purchasing power. People don't really realize this. Okay. And in a low interest rate environment, purchasing power is the most common reason that I see that people can't afford to buy what they want on Oahu. So for some clients, they may need to relocate to a different part of the island because they can't afford to buy in town. Or I've seen in some case scenarios, they have to move to the mainland to buy real estate and live on the mainland. And so just looking at the numbers, the average single family home in 2000 was selling for about $295. Now, if I wanted to get that same exact house today, that same house would be $755,000. So if I was just sitting on cash that represented a down payment and it wasn't growing at 4.84%, I would not be able to afford that same house today. So it's very important that we realize that. Okay. So the question is, are we working for our money, or is your money working for you? So different ways to reduce your purchasing power risk. And this is a more conservative approach. And I'd recommend a conservative approach, the smaller the time frame is, and then based on need as well. So in a conservative approach, we look to invest in higher interest paying savings account or short-term fixed rate investments like CDs. The benefits often are you're reducing your purchasing power risk, because instead of earning 0.02% in your basic savings account, you may be earning 0.4%. Okay. It's generally liquid, so it's easy to get a hold of, and principal risk is often very, very minimal, if we utilize investments like CDs. Some considerations would be in a higher interest rate paying savings account, you may have account minimums. And then oftentimes based on interest rates and where they're at today, you may not maintain or improve your purchasing power over time. Again, because that number we're looking at is 4.84%. Then there's a more moderate approach. So we're looking at putting together a diversified blend of fixed rate investments like CDs or bonds, and then mixing in equity investments such as stocks and mutual funds. There's one strategy that I've implemented for clients in this moderate approach, and I can share that offline with you folks, but I don't want to get in too much detail. But essentially, it's to help clients keep up with the growing growth rate of real estate in Oahu. And so some of the benefits are that you could potentially maintain or maybe increase your purchasing power over time. But considerations are, because you're taking on some risk with bonds and stocks or mutual funds, that there could be low to moderate principal risk. Next would be a more aggressive approach. So invest in aggressive investments such as cryptocurrency, your Bitcoin, commodities, and then stocks and mutual funds. Benefits would be, based on timing, you could potentially increase your purchasing power, but also considerations may be that if there's a pullback in cryptocurrency, if there's a pullback in the stock market, there can be moderate to high levels of principal risk. So when looking at the numbers, I'll generally look at and use this scenario when educating people about purchasing power risk. So if we look back to a client that back in 2010, they saved up $60,000 to represent 20% down for a home, for a purchase of a home. Okay. So back in 2010, the average price for a single family home on Oahu was $592,000. Okay. So based on the increase of 4.84% each year, the end of last year, that same house would have been $755,000. So in the first scenario, $60,000 would have represented about 10% of that home in 2010. But now we got to factor in that if you wanted to put down 20%, it'd be an additional, we'll call it $60,000. Or to maintain its purchasing power and buy that home at $755,000, that new 20% figure would be $151,000. So it's very, very important to realize that over time, because of the appreciation of real estate, your money needs to grow at that 4.84% rate. So looking at the three different strategies, conservative, moderate, and aggressive, and these are just very high level that if you wanted to look into more specifics, I'd be more than happy to sit down with you. But these are strategies that I often see people implement based on their risk tolerance. So in a conservative strategy, a one-year CD, people just buy a one-year CD at the maturity, they'll just roll it into a new one-year CD. So I took rates from today so that if that person had $60,000, put it into a CD and just rolled it into a new CD each year, that amount would have grown or accrued interest of $5,229. So there's still 85, we'll call it 86,000 short from their 20% goal. So they have to find 85% in other savings methods on top of what they saved initially from that 60,000. In a more moderate strategy, and this is more of an inflation protection strategy that had an annualized return from 2010 to 2017 of 6.52%. So again, 60,000 growing at 6.52% annually would represent 99,500, we'll call it. So the difference that would need to be made up is slightly less at 51,500. And the last strategy, let's just say if someone were to invest in Apple stock since 2010, and due to the market performing well and Apple stock performing well, it would have accrued an annualized return of 25.79%. So again, in 2010, that would have represented $60,000. And up until the end of last year, that $60,000 would have grown to $376,000 and would have been $225,000 in excess of that 20% goal. But keep in mind, the stock market has performed pretty positively since the mortgage crisis in 2009, but there is risk involved in each strategy. Okay. Now, this is kind of shifting gears into really looking at real estate as an investment. So, you know, renting it out and then having a tenant. So people really need to focus, and this is the most common mistake I see, is that we need to focus on real return, not nominal return. So real return is, you know, returns after mortgage is paid, improvements are made, property management fees, and appreciation of value, okay? Versus nominal return is people look at that 4.84% and think that that's their actual return. They have to factor in other expenses, mainly being a mortgage. So in a real high level, you know, view of things, again, 4.84% is the average increase for a single family home on Oahu. If you're paying a mortgage at 4% interest, your nominal return is 4.84, but we haven't factored the money that you have to pay back to the bank for that mortgage. So your real return is less than 1%. And this is something that people oversee time and time again, but they need to realize they need to understand to realize their actual return. So when understanding your return, again, it's very important to understand mortgage principal and interest. So a 30-year mortgage that you're taking out, $500,000 at 4%, of course, the principal is going to be $50,000, but what you're going to be paying in interest to that lender or bank is roughly $360,000, which represents a total amount of roughly $860 that is going to the bank for you borrowing $500,000. Okay. Also, you want to look at property management fees. If you're looking at, you know, monthly expenses for someone to manage your property, probably going to be in the range of 7 to 10%, but it's important to measure that real return. And so how to improve your real return when investing in real estate? Put as much cash down as possible. You know, if you're able to put 100% cash down, you will have a real return of, on average, of 4.84%. So really eliminating or reducing the mortgage amount and interest will improve your real return. You know, the flip side of that, it may reduce your cash flow, obviously, because you're putting more cash down. But again, it will tend to improve your real return. So something that I don't see that often if there's high turnover with tenants is that you want to try to increase your rent over time to keep up with inflation. So if I'm renting from someone and it's been 15 years, it's a deal for me because that, you know, my rent probably isn't adjusted to inflation. Okay. So the longer I stay in that unit with the owner not raising my rent year over year to adjust to inflation, it's going to be a steal for that tenant. And then again, factor any property management fees to get a real accurate figure on your real return. So in closing, you know, the next two slides are going to be takeaways for buyers and takeaways for investors. For buyers, it's really understanding your purchasing power risk. Okay, and again, I'll reiterate, if your money isn't earning 4.84% over time, you're potentially losing purchasing power. Okay, again, is your money working for you, or are you working for your money? Understand principal risk. The shorter the time frame, the more conservative approach should be taken. With a more flexible time horizon, then additional principal risk may be taken to maintain or increase your purchasing power over time. And then plan by budgeting, saving, and investing. So depending upon what type of investment strategy you want to use, the difference can be made up by budgeting, saving. Okay. And takeaway for investors, again, the error that I see oftentimes is really understanding the difference between real return versus nominal return. So again, be sure to factor in mortgage payments and interest rates or interest over time. And then also those property management fees and costs. Okay. Consider increasing rent over time to keep up with inflation. And then again, putting more cash down to reduce mortgage costs and improve real return. So if you have any questions or want to get into more detailed about that moderate inflation protection strategy, I'll be more than happy to review your current strategy. Or if you have any friends, family members that really want to get a better grasp of understanding purchasing power risk, I'd be more than happy to sit down with them. So that's all that I have, Janine. So if you want to open it up for questions, be more than happy to.
Yeah, and I wanted to add, going back to the costs to factor in, just to keep in mind the taxes, especially for the investment properties. And I know last week we had talked about some strategies, taking advantage of depreciation, for example, to save on taxes. But that's something I see often, that's overlooked as a cost for the real estate investments.
Mm-hmm.
Now, what are your thoughts? Typically financial advisors and realtors have, opposing views when it comes to investing in the stock market versus investing in real estate. Do you have any thoughts on that?
Yeah, I'm more so along the lines of just working as a partnership with a client's realtor, because I don't believe that 100% of someone's assets should be invested in the stock market, nor do I believe that 100% of their assets should be invested in real estate. So really looking at their time horizons, looking at their risk tolerance, and then seeing what type of strategy that they want to utilize. Again, me personally as an investor.
Investor versus, personal residence.
Yeah. And so it's really important to really look at time horizons and then also see, what type of risks you're taking on. But I'd prefer personally as an investor, I want to invest in real estate. I want to invest in the stock market because I want to have a diversified strategy where I don't have all my eggs in one basket. But when looking at each strategy, you really have to look at the real return versus the nominal return. Again, I can't repeat that enough.
Yeah, that's really good to know. See, I don't think we have any other questions. So yeah, thank you. Next week we'll be looking at the lending side of real estate, and I'm really excited to have Darren Ogino as our guest. So please join us. If there's any questions about what James talked about, his contact info is on the screen. You can also email us at info@smarttaxhawaii.com, and we'll get you connected. Again, James, for being on the call and sharing your expertise with us.
No, as always, thank you for having me, Janine.
Mm-hmm. Yeah, we'll see everyone.